Today I'm going to talk about petty cash. Firstly, what is petty cash? Petty cash is the amount of cash kept on hand to pay for many expenditures, such as postage, office supplies, etc. The operation of petty cash involves three main activities. The first one is to establishing the fund. Second one is to make payments from the fund. And the third one is to replenish the fund. Now let's look at how to establish the fund. Say we want to establish a petty cash fund of $100. We debit the petty cash for $100 and we credit the cash amount by $100. The entry increased the petty cash and decreased the cash. Notice that there is no change in total assets. After the fund is being established, we can use petty cash to pay for many expenditures. However, as the cash in the fund decreases, the fund must be replenished. To do so, the remaining cash in the fund is counted, and the company cashes a check for the amount that brings the total cash in the fund back to the original balance. The receipts in the fund are then used as a documentation for recording expense. When a petty cash fund is replenished, the amount of cash for replenishment should equal to the total amount of receipts. However, this is not always the case. Sometimes the custodian will obtain all receipts. Sometimes the custodian will not obtain all receipts or will give incorrect change, resulting in discrepancy between cash needed for replenishment and the amount of receipts. In such case, the discrepancy is charged to an amount called cash over and short. Cash over and short is a temporary account that can have either debit or credit balance, depending on the situation. Here is an example. In this case, check must be written for $87 to fully replenish the fund. However, there are only $85 of receipts. The $2 difference is charged to the cash over and short accounts as follows. In this entry, the cash over and short account is debited, which indicates an increase to the expense. Thank you for listening.